This is Suzanne. She just turned 72 and has seen her first required minimum distribution. Now it's quite a bit higher than she thought, and unfortunately so are the taxes on this required minimum distribution. Now Suzanne is really wishing that she dealt with this issue earlier in retirement to lower RMDs, but the past is the past and she sits here today. Is there anything that she can do to minimize RMDs moving forward? Hi, my name is Eric Shadak from Safeguard Wealth Management, and in today's video we're going to talk about what you can do to minimize required minimum distributions when you're already forced to take required minimum distributions. Now, minimizing RMDs once they've already begun seems like a difficult task, and it is, but is essential for a subset of retirees that find themselves in one of these given situations. And so take Suzanne, for instance. She's 72 and she's already seen that her RMD is putting her into some tax trouble. It's an RMD that she maybe doesn't need, but is forcing her into higher brackets. Well, the problem here for Suzanne is that if she leaves her RMDs untouched, they will likely grow through the future and become a larger and larger issue. And the reason being is because of something that our team calls RMD creep. Now, RMD creep is this trend that we see when retirees are in their 70s and even moving into their 80s, where we tend to see that an RMD grows through time. There's two core reasons for this. The first reason is the withdrawal rate that you're forced to take from your tax-deferred accounts is typically smaller, where we tend to see growth outpace your withdrawal rate, especially earlier in retirement. Now, your withdrawal rate will grow through time because the government will force you to take more and more from these tax-deferred accounts. And so these two forces cause RMDs to grow as time progresses. And so what can retirees do to combat RMD creep? First off, let's start with a very common question. It's usually where most retirees' minds go if they have an excess RMD that they don't need. And that question is, can I simply just convert that RMD to a Roth IRA? So let's say that we have a $50,000 RMD that we ultimately don't need. Well, many of us would like to convert that into a tax-free account, but unfortunately the IRS does not allow you to Roth convert an RMD. Now you can convert up and above that required minimum distribution, but you cannot convert that RMD, unfortunately. But even though you can't convert your RMD, minimizing RMDs while you're taking RMDs will center all around Roth conversions. Wait a second. So you're saying that I can't convert my RMD, but Roth conversions will be integral in helping me avoid future RMDs? Yes, you heard that exactly right. You can't convert your given RMD, but you're able to convert up and above that RMD. And so depending on what your tax graph looks like in any given year, there may be additional room for a Roth conversion, paying a little bit more in taxes today, in order to set yourself up to minimize RMDs in the future. Let's explain this conceptually in terms of a specific tax hurdle. So let's take a retiree that is subject to IRMAA because of their required minimum distribution. Now, for those that don't know, IRMAA is a mandate where if you show too high of income as a retiree, you will be forced to pay higher Medicare expenses in terms of your Part B as well as Part D premiums. Now, IRMAA is based on a 2-year look back and is based off your AGI, and so you don't get to take the standard deduction when calculating whether you are subject to this Medicare premium increase. Now, IRMAA is what we would describe as a tax cliff. Basically what this means is that if you earn just one more dollar than the IRMAA threshold, you will have the full penalty where you are subject to IRMAA. So a $1 increase can cause you to owe thousands extra in your Medicare premiums. And so let's take someone who has an RMD that pushes them about $4,000 more than their IRMAA threshold. Now they still have room in that IRMAA threshold until they meet the next IRMAA step up and see another Medicare premium increase. And so for this specific person, they would benefit from basically filling up that IRMAA threshold. Again, they will have the same Medicare penalty because they've already passed that threshold. And so they can fill in with additional dollars within that given threshold zone and not have any extra Medicare premiums because of it. The hope is they will minimize RMDs by, let's say, $4,000 moving forward at some point into the future, and avoid that IRMAA zone in future years, thus avoiding that penalty from crossing that tax cliff. And so with this simplistic example, you can see that there are benefits to Roth converting even once you're forced to take these required minimum distributions. The point to drive home here is the math gets a lot more complex and difficult to calculate. And so let's go through a few examples here to dive a little bit deeper into this given subject. And what you'll see from the first example is the question of whether a Roth conversion makes sense or not oftentimes comes down to how much you're actually converting. So we're going to take a look at a couple here who has been delaying their Social Security benefit. and now they find themselves in a position where their Social Security benefit fully covers their income need. Currently, based on their tax-deferred assets, they are forced to take a $38,000 required minimum distribution as their first RMD. Now, here's what their tax planning graph looks like underneath the Social Security tax torpedo. And this tax torpedo is created because as they're forced to take an RMD, that RMD is going to force more of their Social Security benefit into now being taxed. Here's where their current RMD falls on their tax planning graph. Now, the problem here, as we discussed earlier, is as this couple ages, their RMDs, due to RMD creep, is going to force them to take larger RMDs and push them to the right within this tax planning graph, pushing them into higher rates. And then the big worry here is when the Tax Cuts and Jobs Act expires in 2026. And now here's what their tax graph looks like right now, and here's what it's set to look like in 2026. And so now we see that the rates that they're trying to avoid become 27.75% when they're in this 15% zone. It becomes 46.25% when they're in the first part of the 25% zone. And then after their Social Security benefit is fully taxed, they will go back to being taxed at the normal federal income rates of 25%. And so we see, based on where their required minimum distribution puts them, they're in the 12% bracket. Now remember, they're seeing a marginal bracket spike because the RMD that's being taxed at 12% is also forcing some of their Social Security benefit into being taxed at 12%. And so what if this couple looked at filling up this 12% bracket with additional Roth conversions? Well, their marginal rate here is 22.2% that they would be paying as an effective tax rate on that Roth conversion. And that makes sense to avoid tax rates that we will see post Tax Cuts and Jobs Act. 22.2 is lower than all of those given rates. And so we can see at the very least, it makes sense for this person to convert and max out this 12% bracket. Now, what if this couple did a slightly larger Roth conversion? Rather than just maxing out the 12% bracket, let's say they did a $50,000 conversion. Well, all of a sudden, we start to lose some of the value of that given conversion, and here's exactly why. So with that $50,000 Roth conversion, they would be maxing out that 12% bracket, but then they'd also be moving into the 22% bracket. Now, this necessarily wouldn't be that bad if it wasn't for the Social Security tax torpedo, but because of the Social Security tax torpedo, we see that they're incurring quite a bit of tax liability as they move into that 22% bracket, because they're seeing their marginal rate spike to 40.7%. So that's a lot to pay in taxes and incur in extra taxes, but a $50,000 conversion really doesn't use enough of these additional zones in order for that conversion to start to make sense. They'd be better off just simply maxing out that 12% bracket. But what might be puzzling for some retirees is the biggest benefit would actually come from almost fully maxing out the 22% bracket. So going all the way past that 40.7% zone and maxing out as much of that 22% bracket as they could. Now, they won't fully be maxing out that 22% zone because there's an IRMAA threshold that falls just slightly below the start of the 24% bracket. But essentially what they are doing is they're taking this tax hump, but rather than just doing a medium-sized conversion and falling right past that 40.7% zone, they're fully using that 22% bracket and spreading that hump across additional zones here. So their total effective tax rate would be about 23.8%. And again, if we're paying 23.8% as an effective tax rate on that Roth conversion, once again, that makes sense to avoid the 27.75% zone we see after the Tax Cuts and Jobs Act, the 46.25% zone that we see as the new hump post-2025, and then avoiding the 25% bracket, which the 22% bracket is transforming into that 25% bracket. And so we see that they get the most out of a conversion if they fully use the zones available to them. Roth conversions can make a lot of sense for this couple, even though they're already on Social Security and subject to this Social Security tax torpedo. But the exact amount that they convert will make all of the difference in how valuable that conversion actually is. Now, if you've read between the lines as we've been going through a lot of these tax graphs, you see that a lot of the benefit that this couple will receive from converting on RMDs right now comes because we're in a window of opportunity because of this Tax Cuts and Jobs Act. They can essentially convert at lower rates right now than they will see post-2025. Now, even post-2025, it can still make sense for retirees to perform Roth conversions. But as we can see, they get an added benefit in this window of opportunity, and the math gets a lot more complex and difficult post-2025. Now, another way to minimize RMDs moving forward into the future is with something called a qualified charitable distribution, otherwise known as a QCD. Now, a QCD is available for those that are over 70 and a half and can be a fantastic way to eliminate an excess RMD that you don't need if you're charitably minded. Essentially what you can do with a QCD is you can take an RMD that you don't need. You can assign that RMD to a 501c3, a qualified charity. And essentially what happens is that excess RMD gets completely eliminated from your tax situation. Now, a QCD is more powerful than other charitable planning strategies because a QCD is what's called an above-the-line deduction. Basically, what this means is you don't need to itemize your given deductions. You can take your normal standard deduction, you can QCD an RMD on top of that and have all of that eliminated from your taxable income. Now, a QCD as a standalone strategy will do nothing to minimize future RMDs. It will only eliminate your current year's RMD. But when paired with Roth conversions, we can see that this can be an especially powerful strategy for retirees. Let me give an example here of what that might look like. So let's use the exact same situation that we were previously talking about, just for simplicity. We have a couple here that has an excess RMD of $38,000. Now let's say that they're charitably minded. And so what they can do is they can take that $38,000 RMD and assign that to their favorite charity. Their $38,000 RMD will be completely eliminated from their tax situation. Now, because we've eliminated their RMD, they're at a 0% tax liability. Any amount of their Social Security benefit that has moved into becoming taxable is underneath the standard deduction. And so they'll owe nothing in taxes if they QCD their whole RMD. And so this opens up an opportunity where we can fill in the lower brackets with a Roth conversion. So as previously discussed, let's say they looked at filling that 12% bracket. Well, now they'd be filling the standard deduction with taxable income. They'd be filling the 10% bracket, which will be the 18.5% bracket. And then they're filling the 12% bracket, which again will be 22.2%. And so that Roth conversion that they're doing, they're paying a lot lower tax rates on that given conversion and taking more from that tax deferred account and converting that into a Roth. And so if this retiree wanted to get a little bit more aggressive on a Roth conversion, they could even go as far as almost maxing out that 22% bracket. Remember, staying below that IRMAA threshold that we see that falls right below the start of the 24% bracket. And so with performing a more aggressive conversion, their effective tax rate on that conversion would actually only be 20.5%. Again, when we think about paying 20.5% to avoid some of those higher brackets that we're seeing in the future, we already know that that makes sense due to this window of opportunity that we have with the Tax Cuts and Jobs Act. In this specific example, if they went as aggressive as maxing out that 22% bracket, they would have more than $170,000 leaving their tax deferred accounts in this given year. And so if you're a retiree that missed out on performing Roth conversions in their 60s, and now you find yourself in a position where clearly RMDs are going to be a problem moving forward into the future, it may feel like you completely missed the boat. And know that you still have options. Those options are obviously a little bit more limited than they might previously have been, but nonetheless, you still have options. For most families, a Roth conversion strategy will need to be the center of minimizing RMDs moving forward in the future. And as we can see within this video, exactly how we implement that Roth conversion strategy can make the world of difference. Now, even after minimizing RMDs, some retirees may still have an excess RMD. Now, what the heck are you supposed to do with an RMD that you don't need? Well, in this video right here, we talk about 4 options that you have with an excess RMD. Now, some of these will overlap some of the themes that we discussed in this video, and some will be completely new. So click here to learn more about your options, and always remember, you don't need more money, you need a better plan. Thanks for watching.